when a market's been depressed too long, too low, too long, and has in effect made a mistake or been confined. When the leashes come off, it often will compensate for it by going to the new reality, but it often will overshoot what you might say is a rational new reality, like, factoring in the price of silver balanced by the decay in the money supply. Divide gold into the price of the S&P and plot that chart over going back a dozen years. And you'll see there was a range that prevailed after gold collapsed in price and in relative value to the stock market. It collapsed down to roughly 50% of the price of the S&P. Either side of that for the last actually 11 years since 2014. And that spread chart, when you plot it, is like a base after a big drop. You broke out of that base in November, relative performance gold to the S&P, and further in December. And when you plot that same chart, silver versus the S&P, you also broke out, except more gushingly. And then when you run a spread chart, a relative performance valuation chart of silver divided into the price of gold, take an ounce of silver divided into gold, express that as a percent. Back in 1979 to 80, silver was 6.5% of the price of gold per ounce. You had this basing pattern, and silver has broken out in spades, exploded.